Hey traders, Jason here from Leavitt Brothers. In today's video, I'm going to discuss Whaley's toy barometer. It is time for an update. So first, a little background. Many traders, many quants, try to use the performance of the market early in the year to predict what might happen later in the year. So for example, some traders will look at, like, this is just a random year, like the first day of the month, and if that's up or down, what does the rest of the year do? Or what about the first week of the month? If the first week is up or down, what kind of predictive value does that have? Or what about the entire month of January? How does that, what does that tell you about the rest of the year? Or maybe January and February combined, or maybe January, February, and March combined. So you have, all of Q1. They try to crunch numbers and see what kind of predictive value the performance of the market has from early in the year, and how does that help us guide us for the rest of the year. The problem with this is all these start with the first day of January. Okay, so Whaley set out to find a single date range that had the greatest predictive value regardless of when it started or how long it lasted. Okay, it could be the middle of December to the middle of February. It could be November something into February. Like, he didn't know, so he just wanted to find what date range would have the most predictive value. And this is what he found. I'm rearranging my calendar here. He found that the range from November 19th to the following January 19th had the best predictive value. That whether that time period was down, up a little, or up a lot, told you a lot about what was likely to happen the rest of the year. So let's go through this. So he called it his toy barometer. Okay, and I just said that the date range was November 19th, January 19th. When the market was up more than 3%, during that time period, he considered it to be, he gave it a bullish ranking. When it was positive, but not more than 3%, he gave it a neutral ranking. And when that time period was negative, he gave it a bearish ranking. And he found that whether that time period when that time period fell into one of those different rankings, bullish, neutral, or bearish, that told you with pretty good probability like what was likely to happen the rest of the year. So let's go through those. So here are all bullish signals, okay, starting with 1950, and you can see here's all the different toy barometer readings. And you can see every single one in this column is positive, and it is greater than 3%. The forward 12-month return, when you get a bullish signal, obviously you can see here is very green. There's a red right here in 1987. There's another red here in 2018. Otherwise, there's a ton of green here. The average of all those green years, the average and median of all those green years, is 17.6% and 15.1%. Okay, so when you get a toy barometer reading greater than 3%, you have really high odds of being positive 1 year out, and the average median gain is pretty solid, like mid to high teens. All right, now let's look at neutral signals. Okay, so here are all the neutral signals. Here are your readings. So you can see all these are positive, but they're not greater than 3%. And then you can see the forward 12-month return is about 2/3 positive, about 1/3 negative. Okay, and when it's positive, the average median gains are 14% and change and almost 10%. When it's negative, you tend to get like 7, 8, 9% down. Okay, so definitely a difference between bullish and bearish. Now let's go over to bearish readings. All right, so here are all the bearish readings. So you can see the toy barometer readings. These are all negative. And then you can see the forward 12-month return is about 2/3 negative, about 1/3 positive. When it's up decent, okay, 14, 15%. But when it's down, it's also down quite a bit, okay, 13, 14%. All right, so if I were to flip back through these, here's your bullish readings. And you can see when you get a bullish reading, lots and lots of green here, very little red, solid. The odds are very good that you're going to have a positive year and post a solid gain. When it's neutral, it's more like 2/3 green, 1/3 red. And then when it's when you get a bearish signal, it's more like 2/3 red, 1/3 green. So this year, we got a bearish reading. Okay, this year is 2022. Today is January 24th, so the time period has passed last week. And during this time period, the market was down 3.5%. So that puts us in the bearish camp. It doesn't mean we have to have a down year. If we have an up year, there's a good chance it'll be a pretty good up year, but the odds are against us. So in addition to all the other headwinds that we're dealing with tapering and the fact that so many growth stocks are breaking down and so many leadership stocks are breaking down, this is another one of those quant studies that points toward this being a challenging year. Okay, since 1950, when we've gotten a bearish signal, 2/3 of the time the market has posted a loss, and the losses averaged 14.5% or so. So it's something to consider as we go forward. Okay, that's all I got. Thanks for listening. Check out my masterclass at the link below, where I talk about this stat and a heck of a lot more. All right, good luck. See you next time.